Welcome to part 1 of Understanding Business Valuations. We're going to take you through the various aspects of what qualifies as a certified business valuation and share some of the more important areas you should know about. First of all, it is important to know that there are essentially 4 types of valuation analysts that are approved by the SBA for preparation of business valuation reports. If your buyer is going to be using SBA financing, then it's very likely that an SBA-approved appraisal will have to be done by an SBA-approved appraiser. The 4 valuation analyst organizations that are approved by the SBA to prepare business valuations include Accredited in Business Valuation by the AICPA, Certified Valuation Analyst by the NACVA, Accredited Senior Appraiser, and Certified Business Appraiser. Those are the credentials you'll be looking for in a valuation analyst. All of Griffiths, Dreher Evans business valuation analysts are certified either through the Accredited in Business Valuation by the AICPA or Certified Valuation Analyst by the NACVA. Regardless of which one you use, you need to know that the SBA requires that the report be done according to USPAP. That's Uniform Standards of Professional Appraisal Practices. Any of these credentialing organizations or any valuation analysts with these credentials will be familiar with USPAP and capable of preparing that report. Let's take a look at what Uniform Standards of Professional Appraisal Practice require. All these steps will be contained or performed by a valuation analyst preparing a USPAP report. But one area we're going to focus on extensively are the 3 valuation analysis approaches required by USPAP. They are income approach, asset approach, and market approach. All 3 of these approaches are required in a USPAP valuation and will make up the bulk of the report. Let's go through each. The income approach. The first element of the income approach is cash flow. In simple terms, cash flow is the return on investment. As an example, let's say you buy a business for $1 million, and that business has a cash flow of $200,000. The $200,000 in cash flow represents your return on investment. $200,000 cash flow on a $1 million purchase, or a 20% return on investment. The second element in the income approach is the multiple. Most businesses, such as small businesses or Main Street businesses, will sell for a 3 to 5 multiple of cash flow. The multiple is essentially the number of years that it takes to get your investment back. So again, if you had a $1 million investment and you're getting a $200,000 return, it takes 5 years to get your $1 million back. That's a 5 multiple. Let's take a deeper look at cash flow. Determining your cash flow is somewhat complicated. There are at least 50 other items that we look at as valuation analysts in determining your cash flow. For the sake of time, we're going to go over most of the common elements. It all starts with the net income on your tax returns. Then, we normalize owner's compensation. What that means is, we try to balance the owner's compensation to fair value wages. Depending on your own unique situation, we can either subtract the value of your wages and reduce your cash flow, or reduce the expenses, which in turn increase your cash flow. Let's say you're a sole proprietor. In a sole proprietorship on your tax return, there's no deduction for the value of your wages. Let's say your wages in the marketplace is a fair value wage of $50,000. If that's the case, then we take your tax return and we subtract $50,000 to reflect the value of the wage that you're providing to the organization. That's not reflected in the books. In another example, if you were a corporation and you were paying yourself a $100,000 wage, but the fair value of your wage was $50,000, we would do the opposite. We would reduce the expenses by $50,000, increasing your cash flow. The next item is normalizing self-charged rent. Similar to owner's compensation, if you own your own building, depending on what you charge yourself for rent, we adjust your cash flow to reflect the fair market value of those rents. The next is discretionary items. Discretionary expenses are those items that are legitimate tax deductions, but yet are not critical to sustaining the cash flow that we're talking about in your business. An example may be a business that holds their company shareholder meeting in Hawaii every year. All the travel expenses would be legitimate discretionary expenses deducted because the purpose of the trip was for shareholder meeting and corporate business. But the fact of the matter is, you could have had that shareholder meeting right there in your office, and none of the travel expenses are necessary to sustaining the cash flow that you have in your business. Therefore, we can look to add that back, reducing your deductions and improving your cash flow, which is improving your value. Depreciation. Everybody has equipment. And when you buy equipment, you depreciate that over a number of years. You pay for the purchase price of the equipment in year one, but you take a deduction for some percentage of it each year. Over the upcoming years, the cash is laid out in year one, and all the depreciation is taken as a deduction on the tax return over several years. Since there's no cash flow actually represented there, we add back depreciation to get to the true cash flow. However, we then turn around and subtract the average cost of capital expenditures. And capital expenditures are equipment purchases. This is actually an expense that's needed to replace the equipment and maintain those cash flows. Now that you've got the most common items, this will give you a ballpark guesstimate on your cash flows for your business. Cash flow times multiple equals value. Multiple essentially represents the rate of return requirement that is developed from published market statistics. We start with the risk-free rate or the riskless rate, which is essentially the 20-year government bond rate. Government bonds are considered risk-free. We look at published statistics on equity risk premium, size risk premium for the size of your business, industry risk premium, which is an addition based on the type of industry you're in, company-specific risk, which for example might have to do with key personnel, and finally, we subtract the long-term growth rate to get a capitalization rate. A capitalization rate is essentially the inverse of the multiple. So looking back again, how many years will it take to get your investment back? If that's 5 years, or if you're getting 20% of your investment back each year, then it's a 5 multiple. If we developed another capitalization rate and the rate of return requirement came up with 33%, then it takes 3 years to get your investment back, or a 3 multiple. If it takes 10 years to get your investment back, then it's a 10 multiple. You get the idea. Cash flow times multiple equals the value. Let's take a quick look at one other important aspect regarding multiple. Here's a graph which shows the multiple for middle market businesses from 1997 to 2005. On the top, we've got businesses with under $100 million value. As you can see in 1997, the multiple was 9.5 times cash flow. But then you look further across the graph and you can see that in year 2000, the multiple was 6.5 times cash flow. What this is telling you is you don't really have any control over the multiple for your business or the capitalization rate. It depends on what the market is doing. And as you've seen in the stock market, markets go up and down, and multiples go up and down also. Looking further at the middle market, you can see that while the multiple was 6.5 in 2000, by year 2005, it had returned to a 9.5 multiplier. Again, the multiple is based on what's happening in the market. As a reminder, most Main Street or small businesses will get a 3 to 5 multiplier, whereas middle market businesses will get a 6 to 10 multiplier. Now, in our next video, part 2 of Understanding Business Valuation, we'll discuss several actual case studies where we can explain how the 3 approaches worked.